Christopher, thank you for that introduction. It's my pleasure to call this meeting to order. The first item on our agenda is the approval of the January 22nd minutes. Is there a motion?
I make a motion to approve.
Second?
Second.
Motion has been made and properly seconded. All those in favor say aye.
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 Ayes have it. Thank you very much. The second order of business is to review the February 2022 investment performance. Christopher, I'm going to turn it over to you.
Sure. Thanks, Don. And PFM will walk through the report. Just a couple quick comments or announcements I wanted to make. The first is that the cash raise that I had discussed or informed the commissioners about over email has been completed. That was half taken from international equities, half from domestic. So we have cash sufficient to fund benefits either close to or through the end of this year. So in the event of any continued volatility in the markets, we won't have to raise further capital to pay the retirees. I also wanted to mention at the May meeting, the flash report will include the annual fee review. I believe that's when we did it last year. So that should be on page 5 or 6. And then obviously we can discuss any of the fees or compare it to how it's looked over the past several years. With that, I'll turn it over to Alex to walk through the February numbers.
Thanks, Chris. Briefly, you can see here, for the month, as well as, on a year-to-date basis, the plan is protecting on the downside, despite the overweight to stocks, both U.S. and international. But I'll take a step back and just, reference the markets briefly. Things have been very volatile since the Russian invasion of Ukraine. Markets, as of the end of the day yesterday, I believe, are actually up slightly from the very first day of the invasion. As of yesterday, U.S. stocks are down 10% year to date. International stocks, however, have underperformed since the Russian invasion. International stocks are down about 12%. On the other side of the coin, fixed income continues to face challenges from low current yields and the expectation of rising rates. Those expectations have changed quite a bit since the start of this year. If you might remember, I think we started the year in early January in sell-off territory with stocks down 10%, dipping down into the negative 12% range in early February, all prior to the invasion. A lot of that was on the expectation that the Fed was going to raise rates potentially 9 times, a 9 rate hike cycle, beginning with a 50 basis point hike in March. And a lot of that was on inflation concerns, and we've talked about that quite a bit. The Russian invasion has caused the Fed to rethink that schedule. It dipped down from a 9 hike to a 7 hike, with the most recent estimates now looking at 5 rate hikes, before this cycle is done. And also starting with a 25 basis point increase down from a 50 basis point. Some of them, and the Fed is obviously meeting today, so we'll have a lot more clarity, this afternoon. Some of that may have allowed markets to recover yesterday. I think yesterday was quite a strong day here in the U.S. It might indicate that the Fed is, certainly looking at, maintaining at least some eye on the stock market. By charge, they look at inflation, which is certainly, here and in quite a way, and employment. Unemployment has continued to dip down, 3.9% and below. So all of that points to, when the Fed charge making a rate hike. More broadly, inflation. Inflation has been here in the U.S. Prior to the invasion. It's certainly been accelerated. Oil has actually dipped down below $100 a barrel. You probably are all well aware, that we don't get, a very large percentage of our oil from Russia, or we did prior to, the ban on Russian oil. Our industrial metals, et cetera, most of that comes from Latin America. We do import some from Russia. But really where, the inflation, ripple effects are going to be felt is in developed Europe, where they're much more reliant on Russia. Economically, I think Russia is about the 11th largest economy. We don't do a lot of finished good exports to Russia. And so, from a fundamental standpoint, a lot of the volatility here in the U.S., in our view, has been caused by, fear, emotion. Raw oil prices are not as high as they were, 10 plus years ago, I think, at the last time we had record gas prices. However, it's the refined gas at the pump, which is higher. In our view, that could go down quite a bit over the next several days. But again, these effects of inflation will be felt. It'll likely have a reducing effect on global GDP. And a slightly reduced outlook for equity markets, particularly in the international front, for year end. On the U.S. side, we expect volatility, and that's what we've seen since the invasion, with some swings to the downside and the upside. But I think as of yesterday, stocks are actually up since the invasion. So, the active managers, you'll see, have done quite a good job in the equity side, protecting on the downside this year. In our view, that's why you have active managers who are specialists, in their international markets, for example. The international component of this plan is much less indexed than the domestic component, and that's by design. And you'll see that some of the the international managers have, at least as of the end of February, navigated this fairly well. So they had less Russian exposure than the index. We would expect that to help them through March. But let's quickly get down through performance. Again, for the month, as you can see here, the total value of the plan, $643,160,824, down roughly 1.6 net of fees, ahead of the benchmark by 30 basis points. On a year-to-date basis point, that roughly 20 basis point or so spread ahead of the benchmark, down about 5.8%. Some highlights within the plan, within large cap, you'll note that PineBridge, continued to add a nice, protective spread over the benchmark. That's been a trend that has been going on, since, for a good part of 2021. You'll notice their year-to-date figures, they're protecting by about 1%. And if you go out to their since inception figure, they now trail the benchmark by about 0.5% net of fees. So, I think that figure was quite a bit higher at some point. We talked about PineBridge last time. We did issue a search almost a year ago for PineBridge. And we continue, we've conducted diligence on those managers. I think we provided updates in the past. We have a good roster of options. But the market, has changed, and, PineBridge was able to weather a difficult period when, the market was concentrated towards the top. A lot of the, strong performers were the largest, market cap names. With greater market breadth, their factor performance has helped them out. And so our continued recommendation is to hold PineBridge, continue to monitor them while monitoring the managers that we've identified from the RFP. It's not closed yet, and we continue to stay in touch with them. I've been getting updates, Surrey has been getting updates, and we continue to have conversations. There was some discussion last month about Pine Bridge and their, amended fee schedule. They offered this plan several years ago. There was some confusion with Pine Bridge on their end as to whether that contract was actually executed. And there was some back and forth over the last, month and a half between, the staff, the city, PFM, and Pine Bridge. And ultimately, I think we weren't able to identify an executed contract. In those discussions, we said obviously, the goodwill of Pine Bridge was clear, the will of the city was clear, and they came back and have offered the sinking fund a 2-quarter fee holiday beginning with the second quarter of 2022, where 0 fees will be paid. That continues through the second and third quarters of this year, after which the ongoing fee for this fund will be 14 basis points, which is equal to, I think, the largest S&P 500 ETF fee in the market. And that was sort of, our target rationale being, this is, something a retail investor could go out and get. In our view, that helps. It's a 2-quarter fee-free period to continue to watch Pine Bridge. Hopefully, they will continue to perform. Again, from a style basis, it's the type of manager we would be looking to maybe insert in as a replacement, quant manager, low tracking error. And so, again, the fee attractiveness of this is something you're not going to see in anything else that we found through the RFP. So our recommendation is to continue holding it. One last note, even after the 14 basis points is quite a big reduction. I think that the plan originally was paying 18 basis points, which itself was a reduction from the proposed 22 basis points originally when Pine Bridge responded several years ago. And I think the sticker price on this strategy is somewhere around 26 or 28 basis points. So it's a significant reduction from, their advertised SMA fee, even after, the fee holiday expires. No indication, there's no commitment to retaining Pine Bridge. They can be terminated at any time tomorrow, the next month, in December. There's no contract that we must retain them after the fee holiday expires.
Alex, I appreciate the negotiation with Pine Ridge, whoever did that concerning the fees. However, I do have a question concerning the lack of an executed contract. Can someone, whether it's Chris or Alex or Adam, explain why we were in a position to not have an executed contract? And what are we doing to avoid that going forward?
So I believe what happened, Fran, is when we have kind of, as you know, the investment contracts are, like all city contracts, are renewed annually. When there's a kind of mid-year change to Schedule A or Schedule B, meaning either the fees being charged or the investment guidelines, often that has to be done either through a letter agreement or some sort of bridge document that's outside of ACES because of just the way the city contracting system functions. I wouldn't necessarily describe it as the most, efficient system given the investment world. So whether it was through, staff error, which it certainly could have been, or something else, the revised Schedule B was never officially agreed to or signed off on. Again, that led to, I think, some reasonable confusion or whatever the right word is with Pine Bridge. Going forward, I'm going to use a kind of a set template. I'll coordinate with Adam, Ellen at the law department, kind of on a standard bridge letter or similar document that can be used kind of intra-year and then automatically filed or incorporated when the contract is next updated per the city ordinance. the following year. So hopefully that addresses your question. And, again, to the extent that was, my error or, issue, certainly take, responsibility, for that. But wouldn't anticipate it happening, again going forward.
Thanks.
Yeah, and like I said, they sent through what to me was sort of a side letter, and I expected that was binding. At the end of the day, it's an opportunity to renegotiate and actually even get a better deal than what was offered prior. But certainly, we'll reach out to Pine Bridge right after this and work with Chris to make sure that this is confirmed and starts April 1st.
No, I get that it gave us an opportunity to negotiate terms. I understand that,
Yeah.
but with a company with $85 million of the sinking fund's money, there are legal protections in place in any contract, and I want to make sure that we're not in a situation where someone could allege that or claim that those protections are no longer in place because there's not an executed contract. That's all.
And and this actually calls to mind something that Pine Bridge mentioned several months ago. Perhaps a little bit a minor concern on their part. In their view, they expected to be getting terminated once the RFP was floated. And so I think in their view, they just said, "Oh, well, PFM has rejected our offer, and we're going to get terminated," and they didn't push the issue very much, which
I'll leave that up to our consultant to make sure that our investment managers understand that simply because the PFM is issued does not mean that they're automatically being
and like I think that was
another lesson to learn going forward. That's all.
And I think that that was certainly conveyed to them this time around, and I think why they even in the latest round of exchanges, they lowered the fee from 18 to 16 and then again to 14. Originally, the fee holiday was set to start in Q3, I believe, or excuse me, Q4. It would be Q4 of 22 and Q1 of 23. So we put it up, and again, there's no guarantees that they remain in the portfolio. So
Great. Thanks, Alex.
Moving
Alex,
on.
let me just ask. Excuse me. Let me ask a question about the 14 basis points. So when is that likely to expire?
That will be ongoing. I guess it will expire at the expiration of their contract originally, which I'd have to zoom out. I think they were hired in 2020. Chris.
That's
Inception.
accurate, but the law, the law department can
17 there.
the law department can opine if necessary. The investment contracts, while they're renewed annually, they're subject to an evergreen opinion, meaning unlike a lot of other city contracts, they don't have to be bid out every 4 years. The way an investment consultant or an actuary or a third-party provider for a deferred comp plan, for examples. So Don, as long as they remain employed by the gas works, and assuming we don't negotiate even a lower fee, that 14 basis points will go on as long as they're managing money for our retirees.
Thank you.
Yep. Moving on. If we want to scroll back left, Bill, I'm sorry. Small cap. Again, active management here on a year-to-date basis. Copeland, underperforming slightly this month. You can see small caps were actually up a little bit in February. However, on a year-to-date basis, Copeland adding almost 3 percentage points ahead of its benchmark, down 5.9 versus negative 8.6. In a similar thread, even though the Rumbline small cap is a passive strategy, you'll note that it is benchmarked to the S&P 600, which we've talked about, a higher quality index than the Russell 2000, which has also outperformed the Russell 2000, on a year-to-date basis. On the international front, international active management combining to add about a percentage point of outperformance just for the month of February alone. You'll note both Acadian and Ernest, significant weights, over 7% of the portfolio each, outperforming their benchmark by over a percentage point. And that helping their year-to-date figures. Acadian still lags a little bit on a year-to-date basis, but Ernest is outperforming quite a bit. And I think that, again, that goes back to our design when we remade the international equity component a few years ago after those searches. It was designed to be, roughly a third, split between the three managers, 2 active and 1 passive. And, through market movements, that's come off slightly, but, again, a higher component of active. You want to go to the next page, Bill? Interestingly, for the month of February, as the Fed decision approached, there was a lot of speculation. Active management actually had a tough time for the month. With most of the active managers underperforming the Barclays aggregate, if even very slightly. Weaver Barksdale, MetLife, both the core and the corporate portfolio, all underperforming their benchmark. Garcia Hamilton, slightly ahead, and Sky Harbor kind of right on top of the benchmark. You'll note, high yield, which had been, I think, having a better year than the broad market last year. Higher correlation with equities, and as a result, downturn certainly in February, continuing into March. We expect active management to get back on track within fixed income. I don't think this is a major long-term concern. Hopefully, again, there'll be a lot of clarity today after the Fed meeting, and the active managers can reposition their portfolios accordingly. But on a year-to-date basis, the fixed income portfolio as a whole is still ahead of the Barclays aggregate. If you look at the top blue line, the combined fixed income portfolio is down 2.9%. The planned benchmark, which is the Barclays aggregate, is down 3.25%. So in spite of an asset allocation which is tilted towards equities, which obviously have underperformed this year, active management as a whole has helped out. Again, our view is that volatility will continue. The U.S. is relatively a little better positioned. That's where the bulk of the equity overweight remains. We'll keep our eye on volatility, but and obviously the resolution of what's going on in Ukraine is a day-to-day issue. Happy to address any questions anyone might have on any topics about that.
Alex, I just have a question concerning the fixed income managers. The active in general, this is a general sort of question. An active manager in fixed income is only able to have a differentiated spread between the benchmark. I think obviously that's probably lower than an active equity manager who does a really good job or has a really good quarter, a really good year. Keeping that in mind, I'm looking at Sky Harbor and Garcia Hamilton, and I know you said they did better, but they do have outperformed the benchmark, even though on everything's on the downside for, let's say, year to date, or July to February, or one quarter, or even 1 month. But seem like their spreads are pretty good versus the benchmark. I think they've done a good job protecting, it seems to me. Would that be accurate?
I mean, I would say Sky Harbor certainly has, they're focused on credit research, and over time, one would expect credit selection to yield a better performance in the overall high yield. They're not taking, any duration risk, there. And so they're operating like an equity manager selecting their issuances. Garcia Hamilton per my understanding, is a little bit unlike some of the other active bond managers in that they retain less plus exposure,
Right.
in quotes. I think that'll, can help in some periods. It can cause a drag in other periods. But one consistent is, we like active management and fixed income. It's been fairly easy to beat these passive benchmarks no matter what subsector you're looking at. A lot of these managers have been in the portfolio for some time, with the exception of the MetLife Credit and the Sky Harbor. We did terminate Lazard, as part of a reallocation not long ago. But it might be prudent at some point just to issue an RFP, see what new strategies are out there. Again, most active managers beat the benchmark. Through the addition of a little plus here and there from those, from the corporate and the high yield managers. We look for really pure credit analysis. And I mean, I think that's, like I said, that's what benefited Sky Harbor over, their inception. I would say the same for MetLife. I mean, that's why they were brought in. We've known the Logan Circle team for quite a while. It's a pure credit, analysis strategy. And, like I said, over 3-5 years and beyond, that's what differentiates a good fixed income manager in our view.
Yeah, it seems to me just that Garcia has been a good ballast during
Yes.
the recent last year, and I was saying it in a positive way.
Absolutely.
I'm very, and that's why that's why you have some of your fixed income to act as a ballast in times of a down market, and they've done it really well. I mean, one year they're 42 basis points over the benchmark. Year to date, they're over 60 basis points over the benchmark. Again, even though mine is not as much, 70 basis points from July to February. I mean, they've been consistently acting as a ballast to the fund, which I like, which I think is a good thing.
And like I said, and there were times when they were a little bit of a drag, but still outperforming the Barclays aggregate, Fran. Even if very slightly. I say a drag. They were a drag relative to what some of the other managers had done, but
Yeah,
still
no, I hear
outperforming. So.
All right, thanks, Alex.
Yep. Any other questions?
Sounds like there are no additional questions. Christopher, thank you, Alex. Is there anything else that we need to cover this morning?
There's nothing else on the agenda, Don. You see the date of the next meeting, which is in May, on your meeting materials. And pursuant to the resolution that the commission passed at the special meeting last week, I will continue to keep the commissioners and designees updated on the progress, if any, on divesting from additional assets, the minimal assets we have in the Russian market. But beyond that, nothing further from staff.
Excellent. There being no additional questions, is there a motion for adjournment?
Motion.
Second? All
Second the motion.
Motion is made and seconded. Enjoy your day. Thank you.
Thanks, everyone.
Take care.
Thanks, everyone.
Have a
Take
good
care.
week.
Thanks, everyone.
Bye-bye.